All right, let's talk about something that the experts at fffinstill call one of the very few free lunches in the world of investing. I'm talking about tax loss harvesting. It's this really clever strategy that lets you take those losses you see on paper in your portfolio and turn them into actual, real-deal tax savings. So let's break down exactly how you can do it.
So here's what we're going to cover. First, we'll get our heads around the big idea. Then we'll dive into how you can spot these opportunities in your own portfolio. After that, we'll tackle the one critical rule you absolutely cannot ignore, walk through how to execute the perfect trade, and finally, how to build a system so this becomes a regular part of your financial toolkit.
Okay, so let's get right to it. What is the fundamental problem we're trying to solve here? Well, in a word, taxes. More specifically, the taxes you have to pay on your investment profits, what we call capital gains. I mean, let me just ask you this straight up. Do you ever look at your portfolio's performance and feel like taxes are just taking a way bigger bite out of your returns than they should be? If you're not in your head right now, trust me, you are not alone. For most folks with a taxable brokerage account, the answer is a big yes. And this is exactly where tax loss harvesting comes in. It's such an elegant solution. And look, this isn't some shady loophole we're talking about. It's a completely legitimate strategy based on the tax code. All you're doing is selling an investment that's down to realize that loss. And that loss can then be used to cancel out, dollar for dollar, the gains you've made somewhere else. Now, this is where it gets really interesting. Just look at the massive difference in the tax rates here. Short-term gains, that's on investments you've held for a year or less, they get taxed at your normal income tax rate. That can be super high. Long-term gains, on the other hand, get much friendlier rates. The real power of this whole strategy is using losses to avoid paying those really punishing short-term rates. And just to put a fine point on it, look at that number. For some high earners, the federal tax on short-term gains can be almost 41%. I mean, that's incredible. So you can imagine when you can use a loss to completely wipe out a gain that was going to get taxed at that rate, well, the savings can be huge. So the theory makes perfect sense, right? But how do you go from theory to practice? How do you actually find the right investments to do this with in your own portfolio? Let's get practical. So what you're looking for really is an investment with three main characteristics. First, the loss has to be meaningful, big enough to be worth the effort. Second, this only works in a taxable brokerage account, not in your 401k or an IRA. And third, and this is key, you've got to have a good replacement investment lined up and ready to go. And here are some real-world examples to make this crystal clear. Let's say a broad market ETF you own is down a bit. Well, you can sell it, lock in that tax loss, and then immediately buy a very similar total market ETF from a different company. You stay invested in the market, but you've booked a loss you can use on your taxes. Okay, everybody lean in for this next part. Seriously, if you only remember one thing from this whole explainer, make it this. We're about to cover the single most important rule in this entire game. Getting this wrong, well, it pretty much negates all your hard work. It is called the wash sale rule. And basically, the IRS created it because they knew people would try to sell a stock for a loss and then just buy it right back 2 seconds later. This rule says, nope, you can't do that. If you do, that loss is disallowed for tax purposes. So think of it like this. There's this 61-day danger zone. You cannot buy a substantially identical security in the 30 days before you sell for a loss, on the day of the sale, or for 30 days after the sale. That whole 61-day window is a no-go zone. So the million-dollar question is, what does substantially identical even mean? Well, this slide makes it pretty simple. Selling Apple and buying Apple right back, obvious wash sale. But selling a Vanguard total market fund and buying an iShares total market fund. They track the market in a very similar way. But because they are different funds from different companies tracking different indexes, you're in the clear. And you have got to watch out for these common traps because they can trip you up without you even realizing it. Things like an automatic dividend reinvestment, buying a few shares for you. And the rule doesn't just apply to one account, it applies across all your accounts, even your IRA, and yes, even your spouse's accounts if you file your taxes together. All right, now that we know the critical rule we have to avoid, let's get into the nitty-gritty. Let's walk through the exact 4-step playbook for executing a perfect, clean harvest. And honestly, it's a pretty straightforward process. On the same day, you want to turn off any automatic dividend reinvestments, sell that losing position, and then immediately buy your replacement. You do it right away so you don't miss out on a single day of potential market gains. Then, way down the road, after at least 31 days have passed, if you really want to, you can swap back to your original holding. And if you're wondering, okay, but what do I swap to? Here are some classic pairings for some really popular ETFs. The whole goal is to find funds that track slightly different indices but give you pretty much the exact same exposure to the market.
We've gone through all the how, but let's talk about the best part, the why. What's the payoff? Let's calculate the actual money you could be saving here. Let's make this totally real. Say you're in the 32% tax bracket. By harvesting a $6,000 loss to cancel out a short-term gain, you can save almost $2,000 in taxes. That's an incredible return for just a few minutes of work.
And you know what? The benefits don't even stop there. Let's say you have more losses than gains in a given year. Well, you can still deduct up to $3,000 of those extra losses against your regular income, like your salary. And if you have even more losses than that, you can carry them forward to use in future years. It's a gift that keeps on giving.
Now here's the thing that really separates the amateurs from the pros. According to fffinstill, the key is to stop thinking of this as a weird one-time trick you do in December. The smartest investors build a repeatable system to make this a core part of their strategy all year long.
And here's a fantastic framework you can use. A simple quarterly review. Instead of scrambling at the end of the year, you just check in every few months. This lets you systematically catch those losses when market volatility creates them, making the whole process way more effective.
Okay, before we finish up, let's quickly go over the biggest mistakes you have to avoid. First, don't let the tax tail wag the investment dog. Never sell a great investment you believe in just for a small tax break. Second, remember that the wash sale rule is everywhere, across all your and your spouse's accounts. And finally, here's a pro tip. You have to adjust the cost basis of your new position. If a loss is disallowed by the wash sale rule, you're supposed to add that loss to the cost basis of the new shares you bought. It's a crucial accounting step, so make sure you get it right.
And there you have it, your guide to tax loss harvesting. You know, this is just one of over 300 different financial concepts you can explore completely for free over at fffinstill.com. So the question I'll leave you with is this: how much are you potentially overpaying in taxes by not having a system like this in place? Follow fffinstill to find out and learn a whole lot more.